And to discuss with us the global economic recovery, well, Leon Perera is standing by. He's from Spire Research and Consulting. Morning, Leon. Well, a day after the Fed declared that the recession is nearing an end, U.S. retail sales fell in July despite the Cash for Clunkers program. What do you think? Do you think the road to recovery will be a bumpy one?
Good morning. Yes, I think the road to recovery will certainly be bumpy going forward. And I think when the recovery comes, which we expect in the case of the US, will be in Q4 of this year, it will be a recovery to weak growth. So I think those are the key themes. You're quite right to focus on the consumption or the retail sales indicator. That is 75% of a US GDP. And I think the thing that's holding that back is basically unemployment. The unemployment level is still very high, 9.5%. That's almost at the historic high level for the US in the post-war period, and that is restraining consumer spending and making it actually show a jagged trend line going forward. It goes up and it goes down. So I think even though we are moving towards a positive growth, it will be a rocky road. And I think even more importantly, when that growth comes, it will be a weak growth for some time, nowhere near the very, very high, very robust levels of growth we saw in 2004 to 2007.
You know, Leon, on Wednesday, the Fed indicated that the economy has returned to, well, a more stable footing. Now, do you think this will give investors the ammunition to justify continued gains in stocks?
Well, I think it will. It will probably give the markets some fillip. Even independently of the statement, I think the stock markets globally in general have been doing quite well, and I think that's in the nature of these crises. Stock markets always lead the real economy in terms of the recovery and growth by about 6 to 9 months, and we're definitely seeing that here. And I think if you look at the Fed statement, the recent statement just 2 days ago, it does sound a slightly more positive, more optimistic note compared to previous statements. But, on the other hand, you have to say that, the Fed wasn't saying that we are in positive growth. We're still contracting at a declining rate. We're still in recession. So in a sense, it shouldn't give markets a boost. But I guess it's in the nature of markets that it will.
Now, let's talk about a popular topic, housing prices. Now, they may be stabilizing, but if they fall further, what do you think? Will this affect the recovery? I'm sure it will.
Well, in theory, of course, if there's a big drop in housing prices in the U.S., it can throw the recovery off course. I think in theory that's always possible. And if you look at the housing indicators in the U.S., the indicators are still somewhat mixed. I mean, some of it does suggest a bottoming out, but we're definitely not out of the woods in terms of housing, even though the prices are very, very low. So I think that there could be some downside, but I think in general we don't see the housing as actually the main arena or the main indicator to focus on, because probably we're seeing some stabilization and improvement, even though it won't be a straight line or be jagged line. But in the second half of this year, I think we do see the housing outlook improving simply because the prices are so low. So I think probably the main focus is really going to be more on unemployment, which will drive more general consumption.
What about the Fed's exit strategy from its easy monetary policy? When will that be?
Well, I think they probably won't change the basic easy monetary policy stance until perhaps 2011 or maybe even 2012. If you look at the economic philosophy of Ben Bernanke, and if you look at the economic conditions in the U.S. market right now, the U.S. economy right now, there are still dangers, there are still threats to growth. There are still the toxic assets that need to be cleaned out from the system. We still have a long ways to go in terms of bringing that unemployment number down and really creating huge numbers of jobs in a sustained way. I think in that environment, Bernanke and the Fed will err on the side of caution, and they will probably maintain easy monetary policy stance for, well into next year, probably into 2011. Having said that, there could be some inflationary risks next year from commodity prices, so I don't think it will loosen further either.
On a brighter note, Germany and France are out of the recession much earlier than many policymakers and economists had predicted. What do you think? Do you think this recovery is sustainable, though?
Well, I think if you look at the world economy as a whole, we are going through a bottoming out phase, and I do believe that is sustainable. That's supported by broad-based indicators. For example, consumer confidence indicators in Europe and other regions seem to be on a stabilization or even uptrend path. Purchasing managers indices, which forecast manufacturing sector output, those are actually trending in a positive direction. And of course, the news that you mentioned from Germany and France, quite surprising. Europe usually takes longer to rebound from these crises than America because of more rigidities in the labor market and so on and so forth. So I think generally it is going to be sustainable, but I think the key point is that it will be weak growth when we do get to growth in Q4. Nothing like, the surging levels that we saw in 07 or even in the first part of 08.
Now, from Europe, let's talk about China. Global markets, now, they're jittery that Beijing will engage in a new clampdown on money and credit. When will China's exit from its cheap credit policy take place?
Well, I don't expect that the interest rates will really rise until 2010, but probably the main mechanism that China uses to control lending is basically the command and control mechanisms that it has to influence or even instruct the main Chinese banks to lend. And I think what happened in the first half of this year was there was an extraordinary surge in lending with tremendous growth, and that fed incipient bubbles in the stock market and certain parts of the property market. So in July, I think the lending has come down. But if you look at the July level of lending, it isn't low compared to 2008. It's only low compared to the first half of 2009. So I wouldn't really describe it as a clampdown on lending. I'd probably describe it as a return to a more normal rate of lending, because with the Chinese economy showing almost 8% growth in Q2, probably now the concern is to prevent overheating. They don't want to overstimulate the economy. So it's more of a return to a normal rate of lending.
What about China's all-important export sector? Is the worst over?
Well, I think it is a bottoming out phase, and I think here China and Germany are probably similar. Germany is another major economy with a big export sector. I think if you look at the latest export figures, they show still a year-on-year contraction, but a smaller year-on-year contraction than you would expect, and a month-on-month increase. So I think that this just shows that sort of bottoming out trend. Probably we will see a positive year-on-year growth for China exports as we get into Q4, and probably going forward it will be month-on-month increases. So in a sense, I don't think we're out of the woods yet, but we are definitely bottoming out and on path for good healthy growth again as we get closer to Q4.
Now, we've been taking everyone on a bit of a global tour with all our questions. Let's come back to Singapore. The economy expanded 20.7% in the second quarter from the previous quarter. Has these GDP numbers fundamentally changed anything in terms of Singapore's economic outlook?
Well, I think they don't change anything fundamentally. They were higher than many observers were expecting, but you have to take into account that there was a strong contribution from the properties, the construction sector. There was a surge in construction due partly to the IRs entering the final stage of the construction. There was also a bounce in the pharmaceutical sector output that's very volatile. So I think there are these cyclical factors that played into it. I don't think that there is a change in the fundamental outlook. Fundamentally, Singapore is still very open, very externally dependent. The fortunes of Singapore will be very much tied to the world economy. So when global demand lifts, as it will, and when we return to a global positive growth in Q4, then Singapore will also recover and step in that, perhaps leading that a little.
Chatting with us, Leon. Have a great weekend. That was Leon Perera, Spire Research and Consulting.